Good afternoon, and welcome to our live webinar, Securing Guaranteed Income in Retirement. On behalf of the entire team at DIETRICH and OneAmerica, thank you for tuning in. My name is Krista Kotelis, and I'll be the conference moderator this afternoon. If you have any technical difficulties with your webinar software, please direct those questions to our tech manager, Lisa Straub, via the question area on your control panel. Any questions asked during the live session will be answered at the end of today's presentation, and they can also be sent via the question feature on your webinar control panel. Any questions that we are not able to get to will be answered offline. Our panelists for today's session are Pete Welsh, Vice President and Managing Principal with the Retirement Services Division of OneAmerica, and Jeff Dietrich, Executive Vice President of Dietrich and Associates. Pete is responsible for the leadership, coordination, and management of all areas of distribution, including sales, service, products, investments, and national accounts with OneAmerica. Jeff works directly with plan sponsors, actuaries, pension attorneys, and the highest rated life insurance companies to provide custom retirement income solutions. And I'll go ahead and the presentation over to Jeff.
All right, thank you, Chris. And I don't know if that was me that was rubbing the speaker, but I apologize, everyone, for that. Let's get down to business. Getting major feedback.
I don't know who that's for, but let's let it clear out for a sec, make sure that everybody's organized, that we've got our sound going. Okay.
Hang in here at DIETRICH, but can't have. All right. Sounds like it's stopped.
Sounds much better. All right. Go ahead, Jeff. You can rock and roll with the agenda.
Thank you. Good morning. Good afternoon, everyone. As you may be aware, our general mission here at DIETRICH is insured solutions for retirement plans. Today, we're going to take a break from the very popular topic of pension risk transfer to discuss a growing trend in the retirement space, guaranteed income for defined contribution plans. We're going to start by setting the table with some general insights into the status of employer-sponsored retirement plans, the need for guaranteed income or lack thereof, and legislative momentum that we've been seeing in the space. After that, I'll welcome our guest presenter, Peter Welsh of OneAmerica, to learn about their latest efforts in the realm of guaranteed income and their experience surrounding the role of annuities to generate guaranteed income. I'm going to say that word a lot today. Some people view that as a bad word, annuity. So we're going to interchange it with guaranteed income because polls have shown that it's a much more acceptable term, at least on the participant level. At the end of the presentation, we'll have our standard Q&A session to address your questions. So please submit them as you have them during the presentation, and we'll address as many as we can at the end as time permits. One of the things that you're going to glean from today's presentation is that we feel very strongly that plan sponsors, administrators, and retirement plan advisors, as well as insurance companies, for defined contribution plans can make a difference in the retirement plan's performance and the retirements of the participants that they benefit. As you can see from this slide, we've used this before, and I think it's very telling as to, and it is a little bit dated. I think it's been updated through 2014 at this point, but the trend continues that plan sponsors continue to shift away from providing the once popular source of retirement income, the traditional defined benefit pension plan, to the defined contribution model. And defined contribution plans are now the primary retirement savings vehicle, where they were originally intended to be a supplemental savings plan. I was reading an article the other day, an interview with Ted Benna, who is traditionally known as the founder of the 401k plan, and he's looking back on 40 years of 401k plans, and who would have thought that something that he found in the code to help a local small business solve a problem would turn into the, using his words, monster that it is today, and that's what this slide is showing. Basically, retirement plans were originally known as, you know, either Social Security or an employer-provided benefit. Now, over 2/3 of private sector employees only have a DC plan, and the mindset around retirement is changing as a result, as is the reality of an adequate retirement for soon and future retirees. One of the main concerns of retirees is outliving their assets, or what we refer to in the industry as longevity risk. Over the course of about 1.5 generations, the responsibility of retirement and the risks associated with it has shifted. It's shifted from the employer providing that traditional pension to the employee in saving for retirement and then spending down once they are in retirement. As a result, employers, employees, the government, they're all starting to recognize some of these deficiencies, and as did Mr. Benna in this interview that I read, with the defined contribution model being the primary retirement savings plan. Recognize that the original intent was to be a supplement, and as a result of its primary status now, vast majority of employers are not necessarily confident that it's providing the retirement income that is needed in retirement. And they feel, most business owners feel, that this will have a negative impact on their plan, or on their business, I should say. What this shows is that we really are underprepared as a industry, as an offering, and as participants alike. As we mentioned, the challenge is that we have this model that is the primary model. We've been making vast improvements on educating participants about saving, the importance of saving. We've implemented auto features to help participants save, but what we haven't done is said, okay, you've saved, now what? There has been some advancements on the investment side using target date funds and managed accounts, but they don't provide guaranteed income. And the only thing that provides guaranteed income is an annuity provided by an insurance company. Participants continue to talk about their fears of outliving retirement assets, and how much do they need in retirement. And it's clear everywhere you look. We're all in the industry, we all read the publications, yet 10%, as of 2016, only 10% of retirement plans were doing something to address the lack of income options in retirement plans. On the other side of things, participants, they are taking action. They're taking action outside of retirement plans, and of the ones that have the advisor that says, hey, take a portion of your account balance and put it into a paycheck replacement vehicle, an annuity, an income tool, the majority of them are happy with it, satisfied. Peace of mind was the largest response as the benefit of an income stream and financial security. They have that peace of mind to retire, to enjoy retirement. As it says here in our last bullet, CNN Money cited that the single biggest advantage of annuities is that you can't outlive them. Any of these other strategies that have been developed, they're great. Conceptually, they're great when everything works as it's planned to based on the design of the product. But the fact is that you can still run out of money. As life expectancies are increasing, people are living longer, medical advancements are allowing for that. It's important to have a secured income through the use of an annuity that will not run out. The government is recognizing this need as well. There's been, just in the last 10 years alone, there's been significant chatter and significant issuances of proposed regulation, safe harbors, regarding the use of annuities in pension plans. There's still a fear on the plan sponsor level of the fiduciary impact of offering an annuity, and that is being addressed and continues to be addressed. It started in 2008 when the Department of Labor issued a safe harbor regarding the selection of an annuity provider, the insurance company itself. Basically, the safe harbor outlined that if, similar to a pension risk transfer when selecting an insurance company, although 95-1 cannot be the basis for it, but similar, if a plan sponsor acts with prudence, if their search is objective and thorough, take into account the costs and fees associated and the reasonableness of them with the product, considers the financial security of the insurer, which is what 95-1 does, and they conclude at the time, very important, that at the time that this decision is made, that the insurer is financially able to make all future benefit payments, and that the cost is reasonable, and that they've done their due diligence and acted prudently, that there is this safe harbor. In 2015, Field Assistance Bulletin was issued by the DOL that further clarified really the whole point about time of selection and what that means. And basically what it means is that it's based on available information at the time. We do not know what the future holds. No one can predict that. But we do know what we know now, and as long as there are frequent reviews of those carriers that are being offered, then that safe harbor is in force. I think that's a little known fact that is out there, and it's important to know that. It's important for plan sponsors to know that they have this ability to offer this and that there is some guidance out there. Move forward to last year and this year, 2017, April 2017, the House introduced the Lifetime Income Disclosure Act. Basically, it's a proposal to amend ERISA to include lifetime income disclosures on defined contribution benefit statements. Let participants know where they're at, how their savings is going to turn into income. One of the things that I've learned about pensions, and one of the most misunderstood things about pensions is what does $1,200 at age 65 mean to a 45-year-old? You know, that's why lump sums are frequently taken when they're offered to pension plan participants. Now we're looking at it the other way. We're saying, okay, you know, you've saved $150,000. What does that mean in retirement? It's important. It's important for the person making the lump sum choice from a pension plan. It's equally important, if not more important, in the defined contribution world that we live in, that participants know what that savings means and how it's going to work in retirement. Lifetime Income Disclosure Act also states that the plan sponsor is not liable for, you know, the accuracy of that disclosure. I think that there's a good basis to use for that disclosure, but it's also additional measure of protection proposed to protect plan sponsors because it's important. Employers play an important role in adding income features to defined contribution plans. Obviously, you are the ultimate one who is going to make that decision. Most recently, and from a legislative perspective, we're going to wrap it up here. In March of 2018, RISA was announced. There are several different RISA bills out there. There's one in the House, one in the Senate. They're different. Peter and I were just Actually, Peter just gave me an update on what OneAmerica is doing in that space with some of their relationships in Congress. But basically, one of the parts of RISA is the inclusion of in-plan annuities and access to lifetime income for participants, and addressing the items of portability. We've talked about fiduciary, safe harbor. The other big knock on annuities, and specifically in-plan annuities, is the portability for participants that are moving from one employer to another. The nice thing about the 401k model is that you can liquidate it and take it with you. You can roll it over. Insurance products, annuities are not, they're not really associated with liquidity. But advancements are being made both on the product side, on the record-keeping side, and being supported by legislation to create a portable environment for annuities. RISA also addresses the selection and the safe harbor, this is what Peter and I were talking about, for a plan sponsor when adding a lifetime income option to a defined contribution plan. The last thing that I want to say from a legislative perspective, even more recent, in August, the President issued an executive order on strengthening retirement security. And while the majority of the order was addressing the use of MEPs, multi-employer plans, and the expanding access to retirement plans for employees who currently do not have them, the general theme of the executive order was to ensure that American workers will be financially prepared to retire. Guaranteed income ensures that Americans will be financially prepared to enjoy retirement. So the need to enhance the DC plan is apparent. Momentum is picking up. Even Ted Benna in the interview, just one more thought on Ted, and he's a local guy here, so always curious about what he has to say. But he said that defined contribution plans should eliminate the ability to take the account balance as a lump sum, except for maybe a small portion, 10% of it, to pay for certain expenses, and that instead the money should be taken as a stream of income. So if there isn't a more, applicable supporter of guaranteed income in retirement plans, I don't know, who that would be. And while it's debatable whether it's the employer's responsibility to provide more than their DC plan offers right now, I think it's undeniable that sponsors have the trust of their employees, and they do have that ability to affect retirement security. Here at DIETRICH, we're here to help. For 40 years, almost 40 years, we've been helping plan sponsors ensure retirement benefits, whether it's through transferring traditional pension obligations to insurance companies or by implementing income options in DC plans. Our role is to provide that access, that expert review. I didn't mention it earlier, but part of that safe harbor, like 95-1, is if you don't have the capability, find somebody who does. Find somebody who knows the market for guaranteed income. Find somebody who knows how to analyze the financial suitability of an insurance company. Find somebody that can give you competitive solutions, whether it's a very researched single insurer approach or a multi-insurer approach. There's benefits to offering annuities and products on an institutional basis, just like you do currently with your plans. That's the whole point of the MEP, is to bring the buying power together of plans that are small enough that they wouldn't have it on their own, bring them together and give them that cost advantage that larger plans have. You see that with group annuities, annuity contracts, guaranteed income. The institutional pricing is more favorable than what a participant is finding when they roll into into an IRA and go down the street to their advisor, and their advisor says, hey, take 20% and buy an income annuity. In addition to the access and the expert support, we have lifetime income disclosure tools that can be implemented with your record keeper, that can be used by HR to show participants what the value of a lifetime income could be based on their account balance, to put that that income amount on their statement. And then lastly, a little bit more look towards the future is Dietrich's ability to provide plan sponsors with an offering where they can actually accumulate income, where they can build a pension within their 401k plan that provides a guaranteed income for life at retirement. It would also allow employees to contribute to this, but the idea, and you're going to see this theme pop up again here in a second, is that the employer contribution, whether it's a discretionary contribution or a match, goes towards providing guaranteed income, giving the employee access to add on to that. But let's take the employer portion and earmark it for income. Let the employee direct the rest of their investments for supplemental savings, as the 401k plan was originally designed to do. So again, it's our mission to help plan fiduciaries, plan administrators, advisors understand the value of guaranteed income, understand the options, and helping you add that and administer it and communicate it to your participants. So today, I'm done talking for now. I'm excited to be able to bring Peter Welsh from OneAmerica to the webinar. OneAmerica is one of the industry leaders in providing qualified plan annuities, and they've recently re-released a traditional offering of theirs called One Pension. Peter, welcome to the webinar.
Thank you, Jeff.
Earlier this spring, you saw an announcement that you're rolling out your One Pension offering. You quickly corrected me and said that it's been around for a while, and it's just something that seems like it needs more exposure now because of what we just got done talking about. So why don't you give us a little bit of background on One Pension and, like I said, why you rolled it out.
Great. Well, thank you, Jeff, and welcome to everybody else participating today. I certainly appreciate it. Well, we hadn't talked about the Ted Bennett comment earlier, but I think I owe Ted a little spiff for his conversation with you, because we couldn't agree more with his take that we do need to start taking guaranteed lifetime income quite seriously. And as we know, in today's market, there's a high demand for it, and you covered many of the points earlier. There's certainly a significant conversation amongst retirement professionals and in Washington about how the defined contribution community needs to step up to the plate here and start guaranteeing these incomes. So we took that challenge to heart this spring, and One Pension is we rolled it out. We feel it's a competitively priced solution that ensures that the employees, once their working life is finished, don't outlive what they typically would have received from their retirement plan. As you mentioned, that's almost always a lump sum as we sit here today. So, but it is interesting to note, and you hinted at it, that it's a plan design. It's not a product. It connects to a product. It connects to the annuity, i.e. lifetime income vehicle, but it's a design that allows plan sponsors to determine how much money they would like to put into the profit sharing plan on behalf of employees every year. Consequently, because it is a defined contribution profit sharing plan, the money is invested in any way that plan sponsors and their advisors decide. It's completely flexible. And then at age 65, or really any other retirement date chosen by either the plan or the participant, the account balance is then annuitized on behalf of the employees for that lifetime income. With One Pension, both employers and employees can contribute. So you referenced earlier, because it is a profit sharing plan, you can add a 401k feature. That's certainly an option. And nobody is suggesting that the employee's money would be invested any other way than how the employees would like it to be invested. It's really just the employer monies we're talking about here. But the key is, once we get to the point of distribution, it's only the employer's money that is used to purchase that annuity. But also, as you said, it's important to know it's not new to us. We actually have been doing this over 40 years ago. OneAmerica's been around 140 years, and we actually got started with this almost exact same structure, the same type of offering back in the mid-'60s, if you can believe it. So now we actually have an old, mostly a runoff book of business where we're actually doing this today. So it is kind of fun. I've been doing this for a couple decades myself, so it's kind of fun to go back into the old toolkit and dust off a few useful tools and have them apply in today's market needs. So it's kind of like what's old is new again for us, Jeff.
Yeah, it's funny. It's funny how that is. I didn't comment on it earlier when we were looking at the graph with retirement plans, the increase in the defined contribution model and decrease in defined benefit plans, but we're actually seeing defined benefit plans make a resurgence where I think anybody, if you asked somebody that 15 years ago, they would have said you're crazy. Nobody wants to do that. And I think one of the reasons is that that flexibility and control that defined contribution plans has, and you say that one pension is designed to offer that same control, I guess, over funding investments. Can you go into more detail as to how that works and why that's advantageous to the sponsor?
Yeah, absolutely. Thank you, because I think that really is one of the keys that we're offering up. Defined benefit plans have a role, and we get that, but the defined contribution offering that we've taken to market has some unique features. Because it is a qualified plan, it allows plan sponsors to invest on behalf of participants. And the plan sponsors, as I mentioned, maintain control of the plan's investments as well as the features of the plan. So these are living, breathing documents that can be amended, as you know all too well, Jeff. It really is designed for that paternalistic plan sponsor to provide that lifetime income for participants, really without the cost and administrative commitment of managing the traditional defined benefit plan. As you know, defined benefit plans require actuaries. They require mandatory contributions, generally PBGC premiums as well. So if the plan sponsor likes the idea, he or she is a paternalistic individual who recognizes the need to create something that an employee can outlive, but just doesn't want to go to all the way to the end of the defined benefit spectrum, we really think the one pension has some flexibility for them, particularly in the context that they can dial up or dial down the contributions based upon their profitability or desires. I did a big media sweep earlier this year, and I kept getting asked, well, how much does the employee get? And I said, well, it depends on how much the employer puts in and how much the investment return is. It's really up to the plan sponsor. If they wanted to mandate contributions to themselves, they could certainly do that, but we're really giving control back to the employers as to how they want to do this. And obviously, when it comes to investing, most employers are going to work with their advisors as they should. So they're fully invested throughout the life cycle of the plan, and the assets are only annuitized once retirement comes. Often plan participants reach retirement age with really no idea how to create income. They get this largest lump sum of their life, and they're just overwhelmed. But with one pension, the participants know they have a steady paycheck. And for many plan sponsors, knowing they're taking care of their employees at retirement can help them ensure more participants retire on time, which is one of your slides earlier, can reduce their costs both in healthcare and workers' comp, those kind of things. I think one of your slides says 88% of employers feel their business is impacted if their employees can't retire. And this is one of our efforts, if you will, to at least take a step in that direction so that we can relieve the stress on the employer, but really most importantly on the employee.
Yeah, I think the interesting, just taking some notes as to what you're saying here, some of the words stuck out to me. Paternalistic, I bet you some folks would argue that paternalism is dead in retirement plans, but I know what we see in the defined benefit space that even when closing a defined benefit plan or lifting out a group of retirees for a pension risk transfer, many plan sponsors still have that paternalistic mindset. It's alive and well, so to speak. Discretionary, I like the idea of discretionary contributions. Again, flexibility is the key here, but really it's the access. One of the things that I talk about at length, both internally here at DIETRICH, and when given the opportunity with clients and intermediaries, is just give your participants access to an income option. I understand that in-plan annuities might be cumbersome. They're not yet there, haven't solved that riddle, so to speak, but it's very simple to add at the distribution point of your plan for a participant the annuity option. You're not twisting anybody's arms to take it. You're offering very sound, secure insurance companies like OneAmerica. And you know, everybody likes it. It's a good idea. But as the earlier slide showed, there's only 10% of the plans out there have it. You know, you use that mentality of adding it kind of at the end. Why is that? Why do you take that approach as opposed to maybe like an in-plan approach, knowing that you have the actuaries, you have the resources to build something like that?
Yeah, well, it's a fair question, and we certainly have been asked it, and the answer is partly in what you've discussed in many respects already around the fiduciary risk. Once that becomes less or gets mitigated through legislation or regulation, maybe we'll think differently. But beyond the risk, there's a couple other things, at least at OneAmerica, we've struggled with. And that has to do really with some of the portability and complexity around in-plan annuities. We feel that we have to earn our business every day here at OneAmerica, and because the assets are fully invested in liquid investments up until the point the employee retires, if we don't do our job, the employer can take that plan and move it to any other service provider they would like. So one, it gives the plan sponsor a little more flexibility. Secondly, in working with some other providers that do have in-plan annuities, I will tell you it's a complicated sale, particularly once you give employees options around the annuity. As we all know, annuity providers, if you've seen one annuity, you've seen one annuity. There's lots of different options. And with one pension, we take the decision-making process out of the employee's hands. The employer money is going to buy an annuity. The only question you have at retirement, is it single? Is it a joint survivor? Is it, 50%? I mean, that's all there is to it. So it's a relatively streamlined process, and certainly it can be, you can throw rocks at it, but we think that if we're trying to solve primarily for that guaranteed lifetime income, and that's the most important thing, then let's make it as simple as we can. So, you know, that's kind of it in a nutshell. By taking that affirmative election away from the participants and putting it in the employer's hand via plan design, we just think that it's going to be a better solution for us. But certainly there, to your point, Jeff, I think there's lots of different ways to tackle this beast, and this is just OneAmerica's attempt at one potential offering.
It's interesting. Sounds a lot like a pension to me. And the participant comes to retirement, they just elect how they want their money paid to them. Well, this has been good. We had a couple questions rolling in here, and you know, want to set some time aside. I'm trying to figure out how to get this up on my screen here. Try to set some time aside for them. I guess any final thoughts before we turn it over to the audience and what they want to hear on where you really think that this industry, from a standpoint of defined contribution plans and guaranteed lifetime income, is heading?
Well, you know, as I said earlier, you know, what's old is new again, and 40 years ago, 50 years ago, we wouldn't even be talking about lifetime or lump sum distributions for the most part, right? So the reality is the annuities have been a bad word in our industry for quite some time, but you know, however, without even realizing it, we're kind of looping back to annuities to give us that guarantee that people are looking for. So that people want something steady, they want something they can count on. And I think as an industry, when I say as an industry now, I'm talking about insurance companies, because to your point earlier, it's only insurance companies that can use the word guarantee. I think we have an obligation to bring something that does provide that security and does it in a cost-effective manner. So I look forward to seeing what questions we can answer here, Jeff.
Yeah, the first one is it's going back to probably the number one question that pops up, and I can comment on this from a standpoint of in general, but I'm curious as to with One Pension, and I know I'm pretty sure you talked about this, but if you could explain again from a fiduciary perspective, what is the exposure, or how is the obligation of the fiduciary fulfilled in the process of implementing One Pension?
Yeah, so the actual annuity choice, if you will, is not made until retirement. So because it's a plan design, all the employer is doing at implementation and really for potentially quite a long period of time is running a defined contribution plan as they would run any other defined contribution plan, except for the fact that the employer monies are going to be directed not so much in the form of a match, but in the form of a profit sharing contribution and then managed alongside with the advisor. The plan design sleight of hand here is that we are limiting the employer's monies to the purchase of an annuity at retirement. So if somebody were to leave the company at, say, 45 years old, you would have in the plan design, they can't get to that money, the employer money, until age 65. At age 65, then they would purchase an annuity. The goal would be through OneAmerica, but it's not a requirement. And the annuity could be purchased through anyone. We have what we think to be a rather slick methodology to make that a very seamless process, but it's not a requirement. So to your point around fiduciary, we never tie the plan sponsor's fiduciary hands, if you will. He is always able to scour the market and reevaluate us, not only today, but decades from now when that annuity is purchased. And kind of to your point earlier, my example, somebody quits at 45 and doesn't get a lifetime income till 65. Some people might bristle at that, but that's exactly how a defined benefit plan works. I mean, that is a defined benefit plan characteristic, that if you quit before retirement age, you have to wait until retirement age to get those dollars paid out to you in a lifetime income stream.
Yeah, and there's nothing wrong with that, and at least in our opinion, because you're kind of protecting your employees from themselves, and you're earmarking these contributions for retirement. They're put there for, and you know, that's what they should be used for. Again, in a perfect scenario. But just to expand on that, a question did pop up here. Why doesn't an employer have a fiduciary responsibility to offer guaranteed income vehicles as an investment in a DC plan? And they do. We're not saying that they don't. What we're saying here is that this is not an investment option in the plan per se. This is a distribution option at retirement that the participant can elect to take or not to take. From a fiduciary standpoint, it is a fiduciary decision to offer the OneAmerica annuity product. Plan sponsors can do that. They can offer a multiple carrier solution. So that is a fiduciary, but we're not talking about the annuity as an investment vehicle in the plan. Similar to that, question came up from somebody that I think it appears to be familiar with the pension risk transfer space and asked if OneAmerica is a 95-1 approved carrier. For those that aren't familiar with pension risk transfer and annuitizing defined benefit obligations, 95-1 is a Department of Labor bulletin that outlines how to select an insurance company, or what they refer to as the safest available insurance company, when annuitizing pension obligations, primarily related to plan terminations, but more recently related to pension risk transfers and lift-outs. Yes, OneAmerica is a big provider of group annuities for defined benefit plans. So I don't know, Peter, if you have anything to add to that, or if we should hop on.
We enjoy that business. It's not the part of the business that I run. I'm more on our record-keeping side, and as you know, Jeff. But no, that's been a very successful business for us for many years now, and we certainly enjoyed our relationship with you through that.
Yep, feelings mutual. Here's a good one. Yeah, this is, okay, so this appears, I'm going to paint the picture here. It appears that participant comes to retirement. They decide to elect the one pension option to take a guaranteed income with OneAmerica. And the question then is, I think it's during that phase, who takes the liability for the volatility in the market? That's part one. And then part two is, does the employee's guaranteed income fluctuate up and down throughout their career and then lock in at retirement? Okay, let me back that up a second, Peter. I'm going to start that. I think I posed that the wrong way. It looks like this is a question of during the accumulation phase. Again, the one pension model is that of a traditional defined contribution plan where the employer has control over the investments. So the accounts are still subject to volatility. It is not yet at that point a determined guaranteed income. The guaranteed income, is not determined until retirement, until the participant makes that election. So there are no fluctuations in guaranteed income during their career that locks into retirement. There are other products out there that, guaranteed minimum withdrawal benefits, things like that, indexed annuities. There are other products out there that can be in-plan solutions that do that, and the participant is taking on that volatility with some kind of floor guarantee. What we're talking about here, and I'll turn this over to you, Peter, to say, once that participant selects OneAmerica, annuitizes their benefit, who takes the liability for the volatility in the market there? You have the asset. Is the participant's benefit going to fluctuate if OneAmerica experiences negative returns?
No, that's the beauty of an annuity. You're giving me some softballs, Jeff. I'm sure we're winking at each other over the telephone line here. Obviously, that is the fundamental responsibility of an insurance company in that situation. And whatever we lock into at that point, whatever the monthly benefit is, we then guarantee it with that word. And that's why you need to do your due diligence on insurers, because the financial ability of that insurer to continue those locked income streams continue for the rest of your life, presuming you picked a lifetime income. So that is on us, and it won't go up. Here's go out. These are these various complexities to an annuity, but the ones we're talking about, just like a defined benefit plan, is a fixed amount. They're not going to be a cost of living rider. Typically with ours, it'd just be a flat fixed amount, but we assume all that risk. If I may, you were talking about the accumulation phase. It made me think about one of the interviews I did over the summer with, I think it might have been the Retirement Income Journal, the editor there. We were chatting for a while, and he said, I think this might be better than a pension plan. And I said, whoa, let's not go there. But I'm interested in why you say that. And he was focusing on just where we started this conversation around the accumulation. He said, well, when I was 29 years old, I worked for a company that had a defined benefit plan. I quit when I was 35, and he's now early 60s. And he said, I get a statement. I know what my pension is going to be from this, company I worked for almost 30 years ago, and it's barely enough to buy a Starbucks on a weekly basis. He said, had I been in one pension, I would have had an account balance, and that account balance would have grown, presumably, if it's well invested and diversified, et cetera, for the last 20-something odd years. Now it might actually be something meaningful at time of 65 when it becomes an annuity. So it was a kind of an interesting take on the accumulation phase that, there's not a fixed income dollar amount during that accumulation phase because the account balance will change. Presumably it'll go up over time, which would then allow somebody age 65 to have a greater benefit. But no, we are definitely on the hook for that amount once it becomes annuitized. And
then to that point, there's another one here that kind of ties in similarly, and I didn't design to give softballs. This is what's popping up here. I think it lends credence to how misunderstood annuities can be, and we kicked this off as talking about annuity as a bad word. You brought it up again at the end, and I'm bringing it up again now. Annuity, because of the different various types out there and all the different hidden clauses and things that go into some of the different types of products, they've gotten a bad reputation, but it is the only way to provide a guaranteed income, and what we are talking about here is a fixed income that is guaranteed for life. To that point, there's a question here from somebody that doesn't like insurance companies. They say insurance companies hold the pencil, the eraser, and the calculator. How's a participant or a plan sponsor advisor going to ensure that down the road contract provisions won't change? Again, I guess going back to the potential for market or unfavorable market conditions, and how do you ensure that is not going to change?
The actual annuity at time of retirement? Is that what we're talking about there? Or?
Yeah, once it's in pay status, and it's going out. Let's use the example that you have somebody that lives to 120. Okay. I always like throwing that out there because the annuity is going to keep paying. What says that you're going to keep paying?
Yeah, well, good, fair question. So, as you know, Jeff, my background before I got in this was a tax lawyer, so I'll put my lawyer hat on for just a moment. A contract, which is really what an annuity is, issued by an insurance company, cannot be unilaterally changed. It takes the agreement of two parties to change an annuity contract. So once it's in place, an insurance company, whether it has the pen or the eraser or something in between, it's not going to be able to unilaterally change its terms. Now, if the terms itself are flexible, then they can work within that flexibility. But the annuities we're talking about are very simple. We designed them that way so there's not much decision making, not much doubt. Now, in exchange for that, there's not a tremendous amount of flexibility around cost of living adjustments and minimum, those kind of things. But if it advantages participating in the market, those kind of things. But it does guarantee a monthly income for life, and we do not have the ability to change the terms once it's annuitized.
It's a contractual obligation. Once that benefit is annuitized, a first person guaranteed through a certificate is issued to the participant, and as you mentioned, it's a legal obligation of the insurance company that is backed by the claims paying ability of the insurance company.
That's right.
And other safety nets as well. I don't know how much time we have, Krista. I'm going to keep going here because we have more rolling in that are interesting me. I think we have a hard stop at 2, but I'm going to keep rolling with this until you tell us not to. Question is, at retirement, is it only the employer contributions that are annuitized, or can the employee add part or all of the accumulation of their contributions to secure more guaranteed income? Reading that one on the fly. Did that make sense to you, Peter?
Yeah, Jeff. Well, we're a good insurance company. We'll always let people buy more annuities if they want. So by design, I'm being a little facetious here, of course. By design, the employer money does become annuitized. Yes. But the employee's money, and it could also include a match, right? A profit sharing plan can have a profit sharing contribution, it can have a 401k feature, and it could include a match. I don't know if there's going to be many employers that are that benevolent toward their employees that they have this profit sharing and a match, but theoretically it could. So any monies other than the profit sharing component could indeed be annuitized, and we could make that part of the initial annuity they purchase or a supplemental annuity at any point in time. And obviously, if they wanted to use other dollars, after-tax dollars or IRA dollars, we, like I said, tongue-in-cheek here, we'll sell you as many annuities as you want. Although we would say you probably shouldn't annuitize all of your assets. That's not the right thing to do. Yeah,
no, definitely not. And again, the concept or the way that we look at it here at Dietrich is that the guaranteed income is important. The way to affect change is through the decision makers, and that's the plan sponsor. So we look at it from the plan sponsor's contribution standpoint. It's always open to the participant to either make that selection if they want to annuitize it, or if they want to annuitize more, to obviously annuitize more if that's in their best interest. Or, worst case scenario, they have something to shop and compare. Because, like I said, the participants now, they are buying annuities. They're just buying them outside the plan. They're buying them in the retail space. So at a minimum, an employer is giving their participants a comparison tool. if nothing else. And I think that, or I know that being in the industry that we're in, that there is more benefit to be generated on the institutional, on the plan level, than there is for participants that are buying them in the retail space.
Yep.
This one's interesting, and this could go deep. And this is, I think, at this point, the last one that I'm showing. I may have another one pop up, but this one's interesting. How do you sell this benefit designed to the employer as a reason to join your company? It expands on that.
How do
you sell this to as a employer benefit, an employee that differentiates maybe them from their competition?
Yeah, so that's a fair question. So I start with the point of reference from a defined benefit plan, right? If you start from your point of reference as a defined contribution plan, one pension looks like we're constantly tying one hand behind the back after another. So if all you want is a defined contribution plan, Mr. Employer, then one pension is probably not for you. And by the way, we sell straight up 401k plans here at OneAmerica all day long, so we can have that conversation. This is a sale to an employer who likes the idea, for many of the reasons you talked about earlier, Jeff, around being somewhat paternalistic, about providing a guaranteed income for employees, about being concerned that their employees at age 65 are probably, absent this, going to get the largest lump sum of money they've ever received and not know what to do with it and be concerned about that. So if it's that kind of employer, then we've got something we can talk about, and one pension would be a possible solution there. Why an employer would sell that to potential employees, if he is sincere about adopting this type of plan design, it has the benefits of a defined benefit plan, which is, at least for this component, Mr. Future Employee, you don't have to put any money in. I'll do all that. You don't even have to worry about investing it. I'll do that with my advisor. And by the way, when it comes time you need this guaranteed income stream, you'll have that, and you will never outlive it. I think all those are very compelling talking points, proof points, that an employer could use to a potential employee on why their benefit package might be better than a straight up 401k plan. But I've had to be very careful with our sales teams and service teams, as well as the some of the folks in the media around this, which is, if you've got a guy or employer who really is offering a 401k plan only because he has to offer a 401k plan to be competitive and wants to minimize the cost to himself, then this is probably not the right solution. But the good news is we've got 40 years worth of history of other solutions that would work for such an employer.
Yeah, and I can tell you at least one of the things that I'm banking on from discussions with my peers, folks that I'm a Generation Xer. If it weren't for working in this industry, I wouldn't know what a pension was until what we've seen in the landscape of the changing pension plans, freezing of pension plans, offering of lump sum cash outs from pension plans, termination of pension plans. It's amazing how in touch people of the younger generations that don't have these plans are with the concept of a pension, because they see their parents or their grandparents have one, or they've helped their parents with that decision as to whether or not to take the cash or to take the pension. And I know that by talking to people my age that have pensions, that are fortunate enough, they value that, and I don't think have any reason to leave their employer when they have a pension. And if that's what you're offering here through one pension, or at least access to a pension-like benefit, I think that it can be a differentiator. And the follow-up, or the second part of that question, was participants or employees like to know how much the employer is putting away, and what is the formula. Again, this is it's just like a defined contribution. The employer, while in Peter's example, it can be discretionary from a standpoint of a profit-sharing model, that the employee would know that. Or if they're doing it under maybe a safe harbor contribution, the employee would know that it's 3% that's going in. or using their match. So it is similar or the same as the traditional 401k model and defined contribution model, where it's very clear what the employer is putting in. The idea is that the participant has access to, and that the goal of the one pension model is to generate income in retirement. And I think that's the end of the questions. I'm going to let Krista do a wrap up now, but Peter, I want to thank you. It's been interesting. It's been engaging. For the community out there listening, I hope that we shed some light on not only the current market for guaranteed income, one of the solutions out there in one pension, and welcome any kind of offline feedback, questions. There was one question: will the presentation be available? We will make the presentation available to anybody who is looking for it. We will also have rebroadcast if you want to hear us talk again. So thank you, everyone. Krista?
Sure. Thanks, Jeff. I think you recapped everything, but that's all the time we have for today, and any questions we did not get to will be addressed offline. And thank you, Pete and Jeff, for a great presentation and discussion. And like Jeffrey said, a replay of today's session will be sent to all attendees via follow-up emails, whether they were able to attend or not. And always a reminder, please keep an eye out for future webinar invitations. And on behalf of the panelists and organizers, thank you so much for tuning in, and everyone have a great afternoon.
Thank you.